Hey, good afternoon, folks. Kunal Desai here from Bulls on Wall Street. I wanted to discuss with you guys today my 7 rules for day traders. One of the things about being a day trader is you need to really have a rule-based system to keep you out of trouble. One of the things that happens in the stock market every day is that there are always a whole ton of variables that are thrown at you. And what you need is some tried and true things to stick to so that when the time comes to make a decision, you have a set of rules to lean on, and that's really going to help your trading. And I think that's something that really has kept me out of a lot of trouble in good markets and bad. Rule number 1, don't add to a losing position. I see new traders making this mistake all the time. You are in a stock that's moving lower, but you are sure it's about to bounce. And if you get out, now you're going to take a loss. So instead, you buy more shares. This is called averaging down, and it's almost always a bad idea. Sure, doing this will bring the cost of your trade down and give you a better average cost, but if the stock doesn't bounce, you'll just double your losses when you finally decide to get out. There are thousands of stocks to trade with new opportunities every day. So why throw good money after bad by adding to a losing position? Instead, when your trade setup is no longer valid, cut your losses and move on to the next opportunity. Guys, this is huge. For the new trader and even for experienced traders, selling your stock for a loss can be so hard because essentially what you're saying is, I made a wrong decision and now I have to accept it. And that's very hard to do in any aspect of life, not just trading. And so what the typical person wants to do is rationalize why they should double up on their bad idea, right? Rationalize why this stock is good, why it's going to go up. And so what happens is you start researching and you start looking for pieces of evidence out on the internet and by talking to people that tell you, hey, the stock that you're in is not bad, it's good, and it's going to go up. And so you cling to that, and all of a sudden your losing investment goes lower and lower and lower. One of the things that I always tell my students is this: just because the stock goes down doesn't mean that it's a bad stock. But what it means is that at some point in building your case to buy this stock, you misanalyzed a portion of it. And because you misanalyzed part of it, right, your timing on the stock was off. And so after you bought it, it went down. And so now to go in and double down on this stock and add more shares, you're essentially tossing your good money after the bad. You're adding in your hard-earned money into what already was a mistake. Because the best stocks, when you get them, they're going to start moving in your direction nearly right away. That means that you analyzed it correctly. And so that's really huge, and just one of the things that you always want to stay away from. I think throughout my career, some of my biggest losses, the ones that really defined me as a trader and beat me down, were the times that I got caught down on a stock, and instead of accepting it, I kept adding shares. And you'll see it time and time and again, guys, throughout trading. You know, stocks can go down for just years and years. You know, this is a stock like that's well known, like a BlackBerry, right? Everybody's used at some point BlackBerry products throughout their lives, right? And this used to be called RIM. You know, RIM is what really was one of the high flying stocks for really a long time. And then it started having, right, it's a just multi-year descent. And I'll tell you what, one of the things about this stock was that every step of the way, people thought the stock was cheap. And I know, having run my chat room, you know, one of the things is I always get people who want to buy stocks in their IRAs and 401ks. And so they always say, Canal, this stock is looking cheap. I say, yes, but how do you know it's not going to get cheaper? See, the strongest thing in stocks is trends. Riding trends to the upside and downside. And when a stock is on a downtrend, it's like a speeding locomotive. It's very hard to get it to stop. And so all of a sudden your cheap gets cheaper and cheaper and cheaper. And so sure, you can add more money and average down, but at some point, right, you're going to run out of money. I mean, what if it just keeps going down and down and down, right? Are you going to add it lower and lower all the way from $70 to $5? You may not have much money left, right? And once again, when a stock is falling down like this, it is looking cheaper. But the reason it's getting cheaper is there's something wrong with the stock, right? Great stocks with a lot going for them, they tend to be in uptrends. And so this is one of those situations that you definitely want to stay away from, and it can save you a lot of money. You know, ride stocks that are in uptrends, and you will always have the wind at your back. Rule number 2, cut your losses fast. It's okay to take losses as long as you can keep them small. Remember that one decent winner will wipe out several small losses. And if the situation changes and a new valid setup appears in the stock you got out for a small loss, you can always buy it again. And guys, this is so huge. It's okay to take a 1% loss or 2% loss or a 3% loss, right? When you can keep them small, you live to fight another day. The biggest thing that your job is when you are trading stocks is to manage risk. You are essentially a full-time risk manager. And the people that make it day in and day out in the stock market for years and years and years, that is the one thing that they all have in common, is that they take small losses. It's okay. You know, when I take a small loss, I just wipe it out of my mind because I know it's getting me closer to my next great win. And so a stock moves against me in some manner that makes it uncomfortable for me on a risk management basis, or makes my setup, aka the reason I bought the stock, invalid. I cut my loss and I move on. Oftentimes that may mean that I get back in the stock again, but when a better setup emerges and I can play the stock again and try to get that winner. You know, case in point, you know, one of the stocks that I was trading last week was this stock Zillow, right? And so Zillow had, it ran up to almost $100 and had a huge, huge pullback right to $80 here. And it pulled back to $79.99. The day that this dip came in, you know, I bought this stock at $8.30, thinking that $80 is going to hold. So essentially what I did was I put a stop loss right under $80 to minimize my risk. I said I'm willing to accept 30 cents on the stock, and if it goes below 80, you know, it probably could fall lower. And so I put my stop loss right under what we'd call a support, which is a level that, you know, should hold to bounce a stock in. The stock broke under $80 and I got stopped out at $79.99. Go figure, by 1 penny. And so I accepted a small 40-cent loss and said, hey, my risk was mitigated. I'll move on and I can reevaluate this stock later as a better setup emerges. And so, you know, this particular day I just took the small loss, and then the very next day, you know, you could see later in the day it came back and tested that $80 mark, and then the very next day it exhibited strength and really cleared its level from the previous day. And so I added back this stock now, even though I added it back even higher than it was previously, but that was okay because my risk was much more mitigated, because I have confirmation that the stock is now starting to move in the direction that I want. And, you know, now the stock is running all the way to $87. Rule number 3, never rebuy a winner without a good reason. Guys, never double dip in a stock that you've made money on the same day unless you have a logical reason. For example, you sell a stock for a nice profit, and then it continues going up, and you're angry you got out so early. So you buy it again. But you buy it without a reason. You just buy it because you feel like you're missing the boat, right? You're getting left behind. And typically what happens is then you'll have it just immediately drop. Don't make this emotional decision. Only buy stocks that have a valid setup with a good risk to reward ratio, period. And so what I mean by valid setup is a setup is a list of conditions that must trigger before a trade is taken, which means that you need to see certain things and patterns to start building your case for why you should buy that stock. And if you don't see it, then you have to leave that stock alone. That's what professional traders do. So when you make that emotional decision just to buy because you don't want to get left behind, almost always you're setting yourself up to take a loss. Rule number 4, never hold a stock overnight when there's an earnings or FDA decision the next day. This is a losing game and can cost you huge amounts of money. For this to be a smart trade, you need to have not only know what the earnings or FDA decision will be, which means you got to read somebody's mind, but also how the market will react to it. Guys, so many times in my career, I've seen good news and the market has reacted to it in a bad way. So guess what? Is the news or the market right? Right? In the end, the market is right because that is what price is based on. Do you think that you have better information and insight than the analysts at Morgan Stanley and Goldman Sachs? No way. Save yourself the heartache of waking up and finding your stock down 50%. Avoid these gambles and take a trip to Vegas instead. Guys, when you're analyzing earnings and try to play them, think about this. At Goldman Sachs or Morgan Stanley, there are hundreds upon hundreds of Harvard-trained analysts that sit there and try to figure out what these earnings are going to be. They have access to the CEOs, they can call the company, and they do this full time. This is all they do. This is their job. So what are the odds that we're going to be able to outgame even those people, considering those analysts almost always get it wrong? It's very tough. When you hold stocks through earnings, it's just a gamble. Are the earnings going to be good or not? But you don't know. There's a lot of things to analyze, and a lot of it is left to luck. I mean, if you look at right now, we're having earnings season. There are so many stocks that Aeropostale, this was a stock we were playing on Friday to the short side, betting on it to go down. You know, this stock has been just getting kind of cheaper and cheaper for quite some time. You can see here, right? Just cheaper and cheaper for quite some time. And so, you know, you would think at some point it's like, hey, the earnings got to be okay, right? How much more bad news can be in the stock? You know, it had already dropped, 30, 40% here. And lo and behold, they announced their earnings and boom, down another 22% in one day. Imagine if you were holding 2,000 shares of this stock at $11, right? You're talking about a pretty hefty, drop. And that's something that, we got to stay away from. That is something that you just can't plan for. And it doesn't have to be just for, weak stocks. Like Pandora's a stock that's been in a very nice uptrend for quite some time. And their earnings came out on Friday and boom, down 13% in one day. So we don't want to hold stocks through earnings because whether it's a good company, bad company, not always can you predict what the heck is going to happen, right? You remember even when Apple, right? When Apple was at $700, people thought that this stock could do no wrong. And before you know it, it's been nearly cut in half. It can happen to any company, guys. Rule number 5, never short strong stocks before 1 p.m. When a stock is running up on news, like a press release or earnings, they often run farther than you can imagine, even if the news doesn't seem very good to you. So never think to yourself, there's no way this stock can go higher today, because I promise you it can. What is in the market, what is illogical often becomes logical. Just look at some of these stocks like SUPN, ROSG, and HEAT from the past. The thing that I found is often these guys will run up huge in the morning and they just don't break down till later in the day. but often it takes a run of multiple days before it even gets there. So wait for that setup before you short sell them. It'll save you a lot of money. Guys, short selling stocks means that you are betting on a stock going down. And it is a very dangerous game unless you are a professional trader. I short sell stocks quite often. 35-40% of my trades are short sells, meaning I'm betting on them to go down. But you have to have a very specific look before you can do them, because stocks can run up much, much farther than you can ever imagine. There are companies out there, especially like in biotech companies and stuff, that can be just really crappy companies, but out of the blue they can just make monster runs. And so, like, you could see this stock, ROSG. This was a stock that was at $1.75, and some news comes out, and that particular day it hits $8, and then a few days later it's at $12, and it runs all the way to $22. And so that this company is probably a piece of crap, and that the news is not that good after you've analyzed it. But even then, stocks can run much farther than you anticipate, because once momentum takes place in a stock and the crowd jumps in, all of the sudden the momentum takes over and a stock can go viral, almost like a YouTube video. They can go viral and they can really, really start to fly before they ever make their way back down. And at some point, logic will take over. But in the beginning, it's all about sentiment and emotions and momentum. And that can cause stocks to really, really make moves. And so you just don't want to get in front of it till after a few days, and it's almost always late in the day when you want to do this, because in the morning you get big spikes in these type of stocks. One of the stocks that we were playing quite often, the last few weeks has been this STXS. And so XTSS is a biotech stock. It tends to run just it's always just a crazy stock. And I don't typically play these penny stocks often, but I like to short them when they come when they rise too far. And so one of the things about this stock is, the first day, everybody said, oh man, there's no way it can keep going, and before you know it, it hits $7. And a few days later it's all the way at $11. And so imagine trying to bet on this stock to the downside. I mean, you could literally lose thousands of dollars very quickly if you don't use your timing correctly. And so you really want to wait for a setup to emerge before you try to short these type of stocks. Momentum begets more momentum. Even in large cap stocks, you see it like, companies like Netflix. I mean, every step of the way this last few months, people said, oh, this is the end of Netflix. And lo and behold, here it goes, just rising higher and higher, right? And so before you get in the way of some of these, runaway trains, you need to make sure that you have a setup in place. Rule number 6, never trade out of boredom. When you are trading, guys, you're putting your hard-earned dollars on the line. For a lot of you guys, you're not going to be professional traders. That may be one of your goals, or you're trading part-time, and you have a job. And that job is where you're making your money and you're paying your bills and looking after your family. So to take that hard-earned money and just trade just to trade is a big no-no. That can really hurt you long term and short term, is when you just trade out of boredom. And I get that itch all the time. The last couple weeks of market's been really, really slow, especially the last 2 weeks, Monday to Thursday, has been terribly slow. And I've just been biding my time, bored out of my mind, waiting for an opening. And you just don't have it. And in the past, in my younger days, I would have just tried to force a trade or trade and keep trading because I would be bored, and I find trading to be fun, right? But the purpose of trading is to make money, not to entertain myself. Trading with the goal of making money and only buying when there's a good reason to. And that's huge. The last 2 weeks, if you're ever, in terms of my own trading, you'll see like a couple weeks ago, my record was really spotty for the first few days of the week, and so I was trading very, very little and very small positions, as I was just seeing a lot of choppiness in the markets. And then lo and behold, the very last day of the market, this is a log on my site of, my alerts and how I trade. The last day in the market, I really went for it. I traded much, much bigger position sizes and much more aggressively so that I could, make my money for the week. And so it's like I kind of stuck around and just grinded it out for 4 days. And then the last day I made like $2,300 or something to really push my week over. And so it's like I just patiently waited, right? Patiently waited for my opening. I traded small and I just tried not to overdo it. And then when I finally saw my opening, I really attacked it, and that's key. Sometimes you just got to bide your time till you see your opening. Rule number 7, scale out of winning positions. You'll hear me talk about minimizing losses a lot, but what's also important is protecting your profits. When you have a nice profit on a trade, sell half of your shares and lock in some gains. Then for the remaining shares, put a stop at your buy price. Now, no matter what happens, you will make at least some money. Obviously, there are certain markets where it's better to trade fast and just sell your whole position. But for the most part, when the market is good, this is your best game plan. You maximize your results that way. So guys, what this means is, for me, it's about dealing from a position of strength. When I have a nice gain, I sell off a partial position. I extract income out of the trade. I call it my income trade. And then I put a stop loss at my buy price. And what a stop loss means is, right, a level to exit if the trade goes against you. So if my stock starts to go down, then I will stop out or sell out of that stock flat on that last half. But I took a profit on my first half, so I can't turn my winning trade into a losing trade, which is a big no-no. But what that allows me to do also is, if the stock goes on a big run, now I have my half a position to really take a wealth building trade where I can get that big 15%, 20%, or 30% type of gains. Because in a bull market especially, you will see stocks really go on runs for, quite some period of time. You'll see stocks really go on some runs. And so even if you have just a few hundred shares left because you sold a partial, those shares start to add up as the stock starts to climb. And so now you're kind of building up your account with a larger percentage gain, but you still paid yourself in the beginning and took some income out of it. So guys, thank you for watching and hearing what I had to say. To learn our exact methods from A to Z to become a profitable day trader, take our course called the Trading Bootcamp. It's a course that will definitely turn any individual into an expert trader that puts in some real work, that can seal profits regardless of your market conditions. I'm 32 years old. I've been doing this since I was 18, and I've made this boot camp to take people from steps 1 to the end on how to do this for a living. I left no stone unturned. It's all encompassing. So thank you for listening, and I will see you guys all soon. Take care.